the theme that we've seen since 2018 started. We've had 76 days where we've seen moves of more than 1%. That's something we did not see in 17. But we're seeing a sector today, the Dow transports today are really taking it on the chin again today. And that's a really focus. What does it say about business? What does it say about the consumer going forward? And I think that's the biggest indicator of today's market move.
Are you concerned by that move in the transports and the fact that it's been underperforming?
I certainly am. But, at some point, that's going to be the leader to the downside. And that might be a chance to start getting involved on the buy side.
Jeff, also banks again weak today. They really can't seem to get a lot of relief. There's two ways of looking at this environment, right? It's like the market is kind of pre-panicking ahead of some economic weakness. Sentiment has become very sour, and stocks have become more modestly valued. On the other hand, this is how the market sometimes signals that there's a really bigger transition going on. So where do you come down?
And that's what we foresee. We expect a global recession to unfold in the next 6 to 18 months. Heightened risk of that, and if current indicators stay on this path, it's hard for stocks to ignore it. You mentioned small caps weak today. They've been weak lately. Expect more of that. When we get to about a year before the next global recession, we see a reversal in large cap versus small, growth versus value, and international versus U.S. Those are the opportunities right here. Not retrenching back to the leaders of the last 10 years, but embracing the laggards. They could be the leaders of the next cycle.
And of course, Rick, we had the ECB this morning, basically signaling that it's tightening its monetary policy, but maybe a little more dovish than we would have previously anticipated. How would you sum that up?
I think that the timeline for Europe to really get healthy is a long timeline. Listen, if you just look at what's going on with regard to the ECB, let's frame it this way. Mario Draghi's term ends at the end of October of 2019. Most likely, there's a good chance there will be no increase in interest rates by the time he exits. They said middle of 19. Many are assuming it could be a bit longer than that. And in terms of the balance sheet, even longer than that. Well, consider, with that much time, what did our guest, Jeff, just say he thinks a recession in the next 6 to 18 months? Now, I'm not saying I agree with that, but let's be tire kickers here. What is Mario Draghi going to do? What's his encore performance? I think this merits lots of observation. And with respect to U.S. markets, listen, our central bank, which meets next week, may have waited too long. Maybe they're trying to make up for lost ground. But no matter how you slice it, the life insurance of a smaller balance sheet, the life insurance of higher rates does give them a lot more latitude to deal with the slowdown. And with the ECB in its current position in Japan as well, should we go into a global recession, I would look at our economy versus everybody else's as a spread. Certainly we may all deteriorate a bit, but that spread will widen in favor of the U.S. and how much or little that deterioration actually is.